All right. So, aside from the turbulence we're having here, trying to get this thing going because my computer's a little messed up, we'll get through this presentation. So, let me start with we are in turbulent times. I'm having trouble working with this. Here we go. So let's talk about what's going on. This quote from Peter Drucker is a reminder that I think we're in a period where you can't think about things the way we used to, and when you think with old logic in a turbulent time like we're in right now, it's going to lead you to bad decisions. And that's part of what Joe was just talking about with professionalizing the way we're approaching investing. But I think you have a really different look about how you're approaching your investment portfolio because the world's changed. And I want to share a couple ways it has. And I think the game's changed completely for people. And the reason is it starts with the fallout from all the things we know have been going on. This is one of the most unusual periods where you have all these events stacked on top of each other. Usually you have breathing room between some of these major issues like the great financial crisis and then the pandemic and then the war in Ukraine. Because they were layered on top of each other, you didn't get past the last problems before you started addressing new problems. So you weren't sure if you were actually covering all the things you were trying to cover or solve for the problems you're trying to solve for as we're going through this. So these are all the things we know that are weighing on it. On the positive side, you have this, change in technology that's really driving things. And it's also distorting a lot of the numbers. So we do have a hard time really appreciating what actual inflation is since the US government hasn't relooked at how they've done the inflation calculations since the 90s. And we've had a couple things happen since then, like the iPhone and Google search engines coming, and now generative AI and the like. So there's a lot of stuff that hits us all the time that is positives, but they take some time to get through. And I think one of the interesting comments at the event yesterday on AI is you have to really be careful about getting to the place where you have enough data for AI to matter. And we're going to be in that mode right now where we're building up the data so that you can then use the AI to learn from the data and then start to get the right outcomes. But with one or two data points, you're not going to be able to use AI for much. So it's going to take some time in some areas, and other areas will adapt it much more quickly. And I think one of the areas that will have a really good application for AI is going to be in biotech, where you can accelerate the trials and the simulations that you're doing at a much greater rate than you ever have, and get things to market faster and cheaper, which should bring down healthcare costs and the like. So I think we'll see some areas, less so in others. And Bill Deuchler just came in after a phenomenal performance yesterday. Yeah. So let me move on. So what's different between then and now? And I'm not talking about, the 1940s here. I'm talking about 10 years ago, where we had central banks aggressively easing to bring inflation to achieve a target of 2% inflation, not to bring it down to 2%. We had zero and negative interest rates. You had Germany and China, and the world was operating the way it had for 20, 30 years before. And they were the big growth drivers, the US and China. US consumers in China were driving everything, and globalization was in, and détente was in, and the world, everyone was generally getting along. The conflicts were minor, and they were really being done in proxy wars, not in Europe. Now we have inflation well over 2%. Interest rates, look at the German Bund. It went from like negative 52 basis points to 3%. Two-year Treasury went from 1 basis point to over 500 basis points. So you're in a world that's quite different. And now you have these three big trends that are going on: of the reindustrialization of the global economy, this deglobalization process that's occurring, and remilitarization that's going on around the world. And what's really driving this is now, because of the events of the last couple of years, starting, I think, primarily with the trade wars between the US and China, started by President Trump, and then moving through all the things we just talked about that have occurred, you really have this push towards military and industrial concerns driving policy, and they're not separate anymore. And China is really thinking about industrial military complex of how they're driving their economy. So I think as we drive through, you're going to see some very different changes. So so let's just take a look. You have inflation improving in a lot of areas. I think it's going to get worse as we move into the fall in Europe, because I think energy prices are going to start to rise again. But this is a basket of advanced and emerging market consumer baskets with 12 different items. And it's the percent of items in the basket that are over 5% inflation. And what they're saying is this is what the household's really living off of. And when you look at this, in the emerging economies, close to 72% of the basket is over 5%. And in the advanced economies, around 63%. That's not a great setup. And even though it's coming down, the course inflation is coming down very slowly. The headline inflation is coming down much faster, but that can reverse much more quickly as well. So that led to a historic tightening of central banks. And this is the percentage of central banks that have tightened. The advanced is in the red and is in the blue. And you can see how that's changing. And it's a pretty significant difference, as you can see. But they're starting to see a breakaway here where emerging economies are starting to cut rates and advanced economies are still in the hold or increase the rates. So I think we're in a very different period here. And this is where the break starts. When you have divergences in policy like this, it leads to very different economic outcomes. So that's something we have to keep an eye on. As a result of the inflationary pressures, you've had this massive move up in interest rates. And this is this is global yields hitting their highest return based on the the Bloomberg Global Ag. And this is a really significant move in a very short period. And the adjustment process to this will take some time. The fallout, you just saw elements of it, whether it was Credit Suisse or whether it was Silicon Valley Bank, whether it's the real estate area. We're not really through those problems yet. So this 5% interest rate changes the game considerably for a lot of people. And it's because indebtedness has continued to rise. And the numbers vary, and there's a lot of different reports. This is from the Institute of International Finance. But if we're looking at over $300 trillion of debt on a $100 trillion economy with a 3% increase in short rates, you're looking at $9 trillion on that is going to debt servicing. And I think the CBO came out with a report today in the US saying that by 2050, the interest costs will surpass all other expenses for the US government. We can't have that. You can't have crowding out of debt servicing against other required spends. It's very unproductive spend. And people forget that debt is the current consumption of your future earnings. You think about that. What we've done is we've kicked the can down the road. A couple of years ago, we wrote a report. Our outlook was called Sending the Bill to the Kids Table. And I think that's really what we're doing right now when we're sitting here accumulating all this debt and not really coming up with productive solutions. If I can just go back to this slide for a minute, one of the problems is during this period when we had these really low interest rates, we had $75 trillion of need to spend on infrastructure around the world. We did some of that, but most of those programs, as you know, came in the latter part of the, in the last couple of years, not being done when we had zero interest rates, but being done when the cost of capital was moving up. And that's a pretty significant change as well. So there are many challenges, but there are some really cool opportunities to think about where we're going. AI is a game changer. I think it'll take some time to really see the benefits. And it's a lot like the blockchain in the early stages. There was a lot of excitement about blockchain, but it took a lot longer for it to work through the practical applications, not crypto, but how companies can benefit from the advances in blockchain. I think AI will be different in certain areas where they have a lot of data. They can move very quickly. So you think of the Walmarts of the world who are sitting on, Amazon, sitting on massive amounts of data. They'll be able to use AI because they have the information. Startups will need to get data so that they can prove their AI. So I think the hype will meet a reality that's a time lag between when it works and when it doesn't. I mentioned before, the healthcare industry is one that should benefit very quickly on that. The energy industry, oil and gas companies using AI their data is massive. And that's where I've said in the past, I think we need to marry the knowledge of the fossil fuel industry with the renewable industry to have the best energy transition we're going to have. And I think what we're finding out, again, one of the big issues is the climate transition is a challenge and an opportunity. There's a lot of money to be made in it, but getting to the grid is going to be hard. We're seeing that around the world. There's a project in France that can power 30,000 homes that is permitted approved, but they can't connect to the grid for up to maybe 5 to 8 years. In the US, we have power projects that are permitted and all ready to go, but they can't connect to the grid for anywhere between 5 and 15 years right now. So this climate transition is going to take longer, and it's going to be, because of that delays, it's going to actually have some inflationary aspects to it because we're not getting the benefits as quickly as we need. But I think the big issues really are going to come down to for how capital flows around the reindustrialization of the global economy. And I think that's the big change of where we're seeing money flow. And I think that's going to have some big dynamic shifting capital away from China in particular, but Germany as well, and other parts, to either places nearby in China or back to the US, which we've talked about. I also think the interesting dynamic around credit becoming more attractive again is going to change investor behavior for a positive. I think it takes some of the speculation out of the equity markets and gets you to a more grounded place. But I think corporations really are in a tough spot right now when you have to think about, as are investors, when you have to think about where you're putting capital to work. It's not just where you think you're going to get the best returns in the near term. It's really what are the implications of geopolitics, of technology changes and the like on the ability to realize those returns over time without massive disruptions. And I was reading today in the FT, Temasek is down at their worst year in 7 years last year, but they highlighted one of the areas they're not going to invest in is areas that are connected to the US-China conflict. And I think if you go on where there are different levels of conflict around the world, you're going to see more and more of them. And that actually creates some other issues as well, which will redirect capital differently than it's been directed before. And when we say in times of turbulence, if you use the old playbook, you're going to have problems. These are the elements that I think are creating that. And it doesn't matter what asset class you're in, because these changes will impact all valuations. So for us, we see 3 seismic shifts and 3 areas that are going to define where opportunities are for US investors, but I think for global investors as well. We're in a more permanent, higher cost of living than we've seen for some time. This realignment of the global order is ongoing, and you see fallout effects of different things. I'll give you one example today. There is a growing problem in the Sudan where the Wagner Group was there, and they were part of the stabilizing force because they had Russia's backing. As the Wagner Group is going through their transition post whatever you want to call the mutiny, aborted attempt, or just a wake-up call for Russia, however you want to describe it, they were big players in managing certain countries' stability. And now that they're out, the warlords are looking to carve up the profits. So that's going to lead to some disruptions that are going on in areas. So you have to look at second and third orders of change that are going on as well. This reindustrialization of the global economy is the big one for me. It's going to be where I think the best opportunities are to build capital. It's going to lead to splintering or these new startups going into the areas that are benefiting from it. It's going to change where people live and work, where immigration patterns go to. So there are big implications from these 3 things. They were then backed in the US by the Inflation Reduction Act, the CHIPS Act, the National Defense Authorization Act. That's on top of the Infrastructure Act and all the other spending we've done, which a lot of that fueled some of the inflation we're dealing with today. But the government told people where to invest, and the private sector jumped on board. And if you're really looking to invest in the safer areas, not that they're not risky from an investment, but safer for where capital is going to continue to move to, follow the money as we've talked about. You can see here where companies are moving capital in the US. It's in the semiconductor and electronics, EVs and batteries, clean energy, biomanufacturing, and heavy industry. It's all the things we talk about and all the things we know. So for us, we're putting money to work in the defense and infrastructure areas that support these changes, materials and the like. and has not been a spectacular place to be for the first part of this year, particularly on the industrial commodities, in large part because China didn't reopen the way we anticipated and the way the world did, because they went with a more domestic focus. And that changed the dynamic around the commodity space and the industrial commodities in particular. But what was changing right now is the new regulations that are being put in place, where they're restricting certain rare earths coming out of China. The US is looking to do the same thing. We're all creating this deglobalization process. It's slow, and it's not, when we talk about these things, it's not all black and white. It's really shades of gray and transitional things, but you're trying to catch inflection points here, and that's what we're looking at. So we're very positive on the industrial commodities space because it's limited. You're moving to a bifurcated world for that, and there's just not that big a supply. We think the energy area, which is pulled back, you've seen the pullback in oil and gas. I think that's temporary, and I think we'll see a shift back up to higher prices there. There are new sources of energy coming on, and the sanctions don't seem to be slowing down the Russian oil as we thought. And I think the Saudis will continue to try and keep their cuts because they need to get prices up. But I think this is another area that there's going to be continued opportunities for some time. We love healthcare and biotech. I think the technology area, we all know the opportunities that are there. I want to point out one thing that's going on in the next 2 weeks. It was announced yesterday that the NASDAQ is looking at a reweighting because they have the percentage of companies over 4.5% in the index now represents 48% of the index, and they have rules that they have to make an adjustment. So on the 14th, they're going to announce which companies, what those changes might be. 21st, they'll make those changes. Obviously, these are the big names that a lot of capital has been flowing into, the FANG names. How that plays out is something we're going to have to see. Some people are thinking it's going to be significant because you get a NASDAQ rebalancing, which will flow to other indexes and the sub-indexes, which could change capital flowing. I think it may have an impact in the short term, but I don't think it changes the reality in the long term. But just be aware, you could see some disruptions coming from indexing, and it highlights some of the inefficiencies that indexing creates when you think that a change like that has nothing to do with valuations other than they've been too good, and they're going to lower the weightings or adjust the weightings in the index away from the too good to the less performers. I think dividend growers are still going to be important. I don't believe we're going to see significantly higher rates in the US. We're getting closer to the peaking of rates, but we're not that much higher. It's helpful for a lot of savers and all that. But I think companies with good dividends, strong balance sheets, and good dividends are going to be very attractive in this environment, particularly because of the uncertainty. You want strong balance sheets in this world. The debt problem is going to hit us soon. I think the special sitch is another area for M&A that you're going to see more companies rethinking business lines that are not generating the types of returns because earnings are going to be under some pressure, because in certain segments of the economy, you're already starting to see pricing power loss considerably, and you're going to have to start seeing discounting, which means the earnings will start to be squeezed. And we're doing that in the face of higher labor costs, which is one of the things that's holding up the core inflation, as is housing. But I think you have to move away from the market to do well. I've showed this slide a lot this year, and I'm pointing out 3 areas that have underperformed for us: defense, E&P companies, and steel. We're not investing for the quarter. We're investing for the next 12 to 18 months and beyond. And we still think these are really fabulous investment opportunities that a little bit of capital flowing to these areas will have a dramatic impact. And in many cases in the steel area, you're looking at multiples under 10. In some cases, 6, 7 times multiples. Same in the E&P. A lot of those companies are selling for lower multiples, significantly lower multiples than the S&P. The defense companies tend to have higher multiples, but they tend to because they have a better contract. They have a better customer in a lot of ways in terms of predictability. But it's interesting. This was as of October 28th, and what's happened with Apple and Microsoft since then is now Apple's over $3 trillion. And so you can't bet against the FANGs in this environment, but there are other places you can invest in. Some people will do some pretty aggressive trimming, I believe, around this change in the NASDAQ. It may be false efforts, but this is going to move some capital, but I do see areas that are not as commonplace as some of the best opportunities as we move forward. So as Buffett said, business is investor's best friend, and we've had plenty of that. But I think it lets you buy a bunch of areas. I think there are parts of the Chinese economy that you can see some real opportunities in now that the Chinese government's starting to better define the work they've done over the last couple of years of taming their large global corporations. I don't know if it's good or bad from a market perspective what they did, but I think they will take Alibaba and make 6 global leaders potentially. So that may be good for them over the long term. We'll have to see, but it has redefined where capital is going to flow where they are. And I think it's created some opportunities. And I think one of the things Todd's highlighted pretty consistently, Mark, is some of the innovative areas that are going on in China and other areas will continue to be great opportunities, but you really have to know what you're doing and have the expertise to go there. And that tends to lead you, as Joe and Todd have talked about for some time, into funds where you have the expertise that can help you do that. But there are real opportunities from this bad news environment that I think are going to do well for people for some time. So I'll stop there, and Mark, we can open up.
Thank you, Steve.
If I could interject, just to not ask a question, but just to reinforce one of the things he said, which is, I think is a really, really important and insightful point, is for the last umpteen years, we've had a lot of investing focusing on the income statement metrics. And as Steve just said, balance sheets matter. And balance sheets going to become the important thing that people do focus on again, because all those things that drove the income statement metrics, falling interest rates and productivity gains through SaaS software and all those things that juiced, and then allowing the companies to buy back their stock and load up on a bunch of debt and shrink their equity base to juice their earnings per share. Those were all just financial manipulations and largely income statement manipulations. And that game is over. So you have to be comfortable looking at a balance sheet and understanding balance sheet assets. And I think that's very much true also, as you know, in the private markets as well.
I actually think, Joe, that's one of when you talk about, don't act with yesterday's logic. This is a perfect example of that in the venture area.
Yeah.
And that change, you have to catch these inflection points. And I think that's one of the inflections, unless it's in one of the budding areas like AI, where it's still early, and the winners and losers, you'll see a lot more of those. But I think you nailed it, Joe, with that. And I'm glad I had one that worked today for insights.
It's a profound one. I mean, this has been coming for a long time. But you're going to see guys like Buffett, who starts with the balance sheet when he looks at the financial statements, right? These guys are just drooling. Right. And there's a lot of people like him out there. It's not just Buffett. He's just obviously the face to a lot of that value-based, Ben Graham-based sort of thoughtful investing, where you're not playing FOMO or not trying to catch the next chunk of assets under management by capturing near-term performance and have a good competitive positioning in a beauty contest with the next institutional investor. It's actually truly investing. And that is about the balance sheet. And that is going to get rewarded handsomely.
Yep.
Duncan? You're on mute.
Hey, I think I was curious. It's interesting. The bond market's finally come to grips with the idea that rates are up and are going to stay up. We're sort of priced a little differently. I was really interested to see the inflation number that came from China yesterday, because, to me, the next thing that could scare the market is, okay, shit, this 5% thing's not working. We're going to have to go to 6%. And while nobody's really talking about it right now, that really would be the next that, we always usually get our butts kicked in the fall. Something goes wrong. That would be the thing that does it. But when I saw that number from China, it's like, geez, if there's no inflation at all in China, how are we going to have this problem we can't resolve, even if we're not resolving it as quickly as we'd like? It would argue that we are going to resolve it. I'm just curious if you had any thoughts on that.
Well, I think there are a lot of people. Druckenmiller and Kevin Walsh, for example, have been out for a while saying that they think the Fed's had it wrong a lot, and we need to lower rates. On the other hand, you have a number of people, Nancy Lazar and others, saying we need to be 6% easily. I think the challenge with that is you also have quantitative tightening going on at the same time. And it's hard to really get the sense of where we actually are right now. I think Powell's done a pretty good job. I think he knew he needed to go a little bit higher, but he's worried about that same part that you're talking about, Duncan, is if you have deflation, we're importing deflation from China right now. That eases some of the inflationary pressures. Do we have to raise rates as much? But at the same time, you have China going down the toilet. Does that slow growth enough that we don't have enough growth to deal with it? So nobody really knows right now where it's going to end up, but I think you're right. The fall is going to be a time that things get a little tricky. And for us, that's why we're concerned about Europe right now, and rising inflation there at a very difficult time is going to be hard. And if they have any energy price increase, which I think there's a higher probability for it than we've had before, the weather patterns right now are so disruptive. I think you're going to end up with a problem there. So hard to say how it ends up, Duncan. I think it's one of the challenges. I had a question for you though, and I haven't followed it as much since you raised it, but you had talked about high yield as an area finally coming back to an opportunity. How is that done, or how is that evolving from your perspective?
Well, it's sort of interesting. I mean, I was screwing around in some of these closed-end funds. I mean, my theory was, okay, par is now 80. Yeah. So I'm closer on a default to my recovery level, which is like a really interesting data point. By the same token, if something good happens, like an event, like Joe was basically referring to, which is basically investment grade companies maybe taking some of these private equity companies out, that's probably where the M&A activity is going to be, because the private equity guys just can't refinance with a debt load at the right price. So, you're kind of loaded with positive convexity events in the high yield market because of the traditional lower coupons. But what's happened here is the whole thing trades better than it should because there hasn't been much issuance. So just the coupons coming in keep adding a nice technical to the asset class. So it's hard to go in there and say I'm like getting a bargain. But I think you end up with like event-driven trades both ways. Some companies are going to go bust. The recovery's probably better relative to new par, if you will. And then the event trades that take you out, are going to take you back to par because the investment grade buyer is probably going to take the debt out. I mean, that's like really big picture stuff, but that's kind of what I think I like about the high yield market. But then it gets into this private credit space. I mean, look, I did a little bit of PA in some of this stuff, and I can't tell you that I made a killing on any of it. It's been nice to just earn some coupon income in some of these BDCs and that. I will tell you, if you look at the alternative asset managers, the one that's outperformed everybody is Apollo. And those are the guys that are most credit focused, which is sort of an interesting data point. Just look at the stock chart. I have one more question for you. And I'm sorry I don't mean to monopolize this. But I'm wondering with the bank earnings this week, the banks have done better and the regionals have done better. And the thing that scared everybody was two things. One was the deposit bases, the stability of those. And the second piece was their mark-to-market portfolios. And if you look, they're non-mark-to-market portfolios. If you look at where the 10-year note, the 15-year mortgage, and the 30-year mortgage was on March 31st, we are literally 60 basis points higher today. And nobody's talking about this. When these guys report, over the next month or so, that mark-to-market, that non-mark-to-market holding has to be worse off now than it was at the end of March. And I'm just curious if that's something that also could factor into the Fed's thinking. And, I don't know. I just throw that out there.
Stability is a big issue. And I just saw there was several global banks were downgraded by one of the big investment banks today from buy to hold, which may be a part of that concern being expressed as well. But I think that's underlying there is one of the big issues. The Fed did a good job. I think central banks around the world did a good job of solving the short-term liquidity issue that was going on in the bank run. But I don't think they've solved the underlying problem, which was people went too long at the wrong time. So I think you're right. You'll see some of those numbers go, and Somebody said earlier that we're overbanked, which is absolutely right. So you'll see a lot of bank consolidation coming.
Paul, you have a comment, question?
Yep. Thank you for that. Yeah. Just, I wasn't planning on kind of replying to what Duncan said, but people are definitely noticing. I talked to a lot of banks and, they're showing out portfolios and they're kind of a little surprised at the levels they're seeing. And it's because I think I'm just looking at the 3-year CMT right now. The low was 452, 3 years, treasury. It's now 546. So that's a 3-month CMT. So that's kind of, you saw that, large kind of increase just over that short amount of time. So we're definitely seeing it. I had a question on personal consumption, Stephen, and I don't know if you kind of hit on this. I missed the beginning, but I guess, where do you think personal consumption is coming from right now as we continue with rates going up? I see credit card volumes are up, but eventually that'll kind of peak out. I have a theory myself, but I'm just kind of getting a sense of, where do you see personal consumption? It's obviously, it hasn't gone down. It's starting to peter out a little bit in terms. I'm just looking at the Fred database. What are your thoughts on personal consumption going forward for the next year?
It's funny, there was a discussion about this today. As I mentioned earlier, I don't think the U.S. consumer will be the same driver they've been in the past, but we threw so much money into the system and into people's hands that they were able to build their balance sheets, their net worths up through that. So it's a really interesting dynamic. I think the consumers has not felt the issues with higher rates yet, but will. And so I'm in the camp that they're not as flush as everyone thinks, but two really smart people at the event yesterday were in the exact opposite camp, which makes markets. So I'm not sure that it's going to work the way people think. I think the money is going to be spent faster and the rate and the issues are going to hit. And I also think the inequality that exists make it hard to look at those numbers and say, all right, that number's on the aggregate is high and it looks healthy, so everything's healthy. I think under the surface, there's a lot more problems. So
yeah, my theory is that the HELOC volume is ballooning right now. So we're seeing massive requests for HELOCs from consumer banks and private lenders. There's $30 trillion of equity in single family residential. So I think that's potentially a source of where the spending is going to come from. But it's yet to be seen. But I think that's my theory, is like you're starting to see these large HELOC draws coming out. And these are obviously higher coupons than where even a cash out refi would happen. But people want to keep their nice first lien at 2 to 3%, and so they're getting a second lien at prime plus 200 to 400 basis points.
Well, the other thing is, I think people are feeling a little flush right now because their houses' values are up. So on a net worth basis, they feel wealthier than they probably are.
Got it. Thank you,
Joe.
If I could just jump in just for a second. Yeah, Paul, I think it's the excess savings that has slowly been drawn down and has been a great insulator, with all the turmoil that's been going on. And my guess is that this increase in the HELOCs, which I think is a very interesting point that you raised, is probably symptomatic of the fact that those excess savings are being drawn down and consumers are now, looking for alternative liquidity in order to continue to finance their wants and needs.
And actually, one of the big credit numbers for consumers is going to break $1 trillion soon. And that's first time ever on that one. So I think there's some interesting dynamics with that going on.
Joe, you want to ask a question?
Yeah, I guess it's as much as, again, just sort of contributing to what Steve's wisdom, but in the conversation around the Powell's challenges and volatility and interest rates and should rates go up or rates go down, to me, when you take a step back and then you throw in the China conversation in there, I mean, we're clearly reshoring our manufacturing. what's driving some of China's problems, right? And there's a big emphasis for that for all the things I think we've discussed. That's going to drive inflation. That's a structural source of inflation. There's not enough people to staff and work on that reshoring of manufacturing here. So they're having to pay up and pay up. So that's I think, a fundamental trend that is going to be a source of inflation, wage inflation and commodity inflation and materials inflation, et cetera, et cetera. But that is a fundamental thing that should be happening. And I hopefully, fingers crossed, we're going to definancialize our economy a little bit, whether it's your unwinding the Fed's balance sheet, shrinking of the banking industry, shrinking of the financial services industry. I mean, this economy became financialized.
Yep.
And it started with GE and Cisco and some of the big companies that were making more money off their financial divisions than they were off of making and selling stuff. And that goes back to the 90s. So the definancialization, the reindustrialization is a structural source of both these conflicts, I think, that we're framing in this conversation, which is the financial volatility and interest rates, and what does the Fed do to manage short-term behavior as we're definancializing, while you've got the structural tide of reindustrializing our economy and the structural inflation components that are just, you can't manage that except through innovation. The only way to manage structural innovation is through productivity gains that come from innovation.
Yep.
Full stop.
Yep. People used to call GM General Mortgage
Right.
years ago in the 90s.
Oh, yeah. Yeah. I mean, GE was a financial company with an industrial subsidiary, and Cisco made more money off of leasing routers than they did selling routers.
Mhm.
So I mean, our economy became financialized in the 90s, and we're just at that end point. And now the definancialization is going to cause a great deal of financial volatility in the near term, trying to navigate short-term wins, while the reindustrialization is going to be a source of structural inflation for the foreseeable future, I think.
And the detente and China into the letting into the big group was a big part of that change. And we're feeling the effects of both.
Any other questions or comments?
Hey, Bill, next week, following your phenomenal presentation yesterday, I think we're going to touch on China. So I'll need your help.
You guys can tag team.
I'll be here.
Okay.
Yeah, Bill, that was, I mean, I don't know what, it was just an amazing presentation. It was raining cats, dogs, and other animals. And I'm sorry, but the audio wasn't fully with you, but we like to almost like create an event around it. It was such great data.
Maybe Bill will start next week with you doing the China slides, and then I'll come in with my presentation, if that works for you.
Sure.
Okay.
They're already done, so no problem.
I'm sure you'll throw in a new one or two in.
Yeah. Little emphasis on doing a little more homework on that. No, it is fascinating, and there's a lot going on there in China and they're trying to get them bail themselves out, which again, as I mentioned, could be a source of deflationary pressure for the rest of the world.
Yeah.
We'll see.
Another, I was looking at you there, and then it made me think of Armin. I was thinking of Erdogan and what happened with I don't know if he's allowed Sweden into NATO, but he was trying to horse trade to get into the EU, and that maybe it was just Bloomberg's interpretation. Then it made me think of geopolitics, and Armin had some really great takeaways from yesterday's. He's the former president of Armenia. He hit a lot of interesting themes about there's likely to be a new world order of sorts discussion after this war. AI was a theme of his. There's some questions around fusion, actually played into his because he's also a physicist. And we were talking about small states. Just there's so much volatility that's actually, you always say that the speed of change is it's getting faster and faster. And then he calls it at a quantum level. And there's always these lags and indicators, and this is just going to get worse. It's just going to get more complicated to navigate.
Yeah, the quote is, the rate of change has never been this great and will never be this slow again. And I think that's when you think about quantum and AI, that's really where they're coming from with that. I thought one of his really interesting comments was around the small nation opportunity, where they get to pick the best of both sides if it's a bifurcated world between the U.S. and China.
Well, you just talked about that though. Temasek basically saying they don't want to play into the conflict. Is that what you?
Yeah, but it's the areas that are defined as conflict areas as opposed to the areas that are not. So you can invest in China if you're an American investor going into China. I'm pretty sure they're not all that concerned if it's a Starbucks is not going to have national security issues, or Nike. But if you get into the industrial complex that has anything to do with national security, energy, or food supplies, that's a different world. So, but for these nations, they're going to get much better deals from playing both sides against the middle, which I think is going to create a power block for a group of smaller countries if they can get it right and stick together. But it's a really interesting dynamic, and I think the takeaway from this for everyone, for me, is think very differently about the future and take the knowledge you have in the past and apply it, but apply it differently because the world's going to be very different going forward, and it's going to be not all bad. That's the other thing. It's easy to get caught up in the negatives, but it's a phenomenal. The changes, the ability to improve healthcare and our living standards is going to be enormous. But we'll get through a tougher period. Have to get through a tougher period first.
Yep. Okay. With no other questions, comments, we'll consider Newport a wrap for us. Going to head home, and next week, what's our topic? Is China. Bill and Stephen on China. Excellent. Thursday, if you're in the city, we're having lunch at Ladresse. Let us know. Bye, everyone.
Thanks, guys.
Okay,
Thanks, Stephen.
good stuff. See y'all.
Good session.
Bye-bye.
See you.